All right, so welcome to Coffee with Markus. This is episode 131, and today we're going to talk about earnings season because earnings season is in full swing. So we'll talk about how earnings season impacts option trading and how exactly I'm trading during this time. All right, so let's get started. This show is about real money and real trades. I'll show you the trading strategies that I personally trade, the tools that I use to trade my own accounts, and we will talk about the right mindset of a trader. Now, talking about mindset, I'm going to show you how to create SRC profits. And SRC stands for systematic, repeatable, and consistent, because that is the key to long-term success in the markets. So, if you are sick of all the hype and empty promises, and you want to learn trading strategies that actually work, then click on like right now and let's get started. All right, good. There we go. All right, so as most of you are aware, it is earnings season. And there have already been some pretty big names that have already reported earnings and some pretty big stock reactions to go along with those earnings reports. Let me just jump to my handy dandy iPad here and show you a few things of what was happening. So let's talk about, for example, last week, Netflix. It rallied, as you can see here, 17% last week. Let me just mark this so that you see it is here, right here. We had earnings and then we shot up 17%. It's kind of crazy, right? And this week, we're likely to see a few more. In fact, roughly 20% of the S&P 500 companies and also 25% of the Dow companies will report earnings this week. So today, we're going to talk about how earnings season can impact option trading, because as you know, I am trading options. Now, just brief intro, earnings season happens quarterly, meaning 4 times a year. Duh, right? And earnings season is when corporations reveal their financial results for the previous quarter. And right now we are in the first quarter of the year, so most companies are reporting their results from the fourth quarter of 2020. Now, the results of a company's earnings report can have a major impact on the stock price, as you have just seen. And options will often price in the expectations for a big post-earning move, and they often price this in before the event. And this is why it is likely that options premiums are more expensive. And one thing to know about this and how it can impact your trading is implied volatility. And see, there are several things that make up an options price, including the market's expectation for future volatility. And that is called implied volatility. We'll show you some examples here in a moment so that you see what it is, because as an options trader, it is super important to understand what implied volatility is and whether it is running currently very high, low, or an average. So why is this important? Well, as an options buyer, higher implied volatility means that you're paying more for your contract. And if you buy an option before earnings and hold through earnings, you put yourself at risk for a so-called volatility crush. Now, part of the reason implied volatility goes up so much ahead of earnings is because traders don't know which way the stock is going to go or by how much. Just think here of Netflix. Who would have known that Netflix would soar 17%? But you see, once a company reports earnings, there's no more uncertainty. And this is when implied volatility drops. And in some cases, so does the options price. So if you bought an expensive option, there's a chance that you have to sell it to close at a lower price, even if a stock moves in the direction you want it to. And let me show you a very, very specific example of a volatility crush and why it is so important that you understand the concept of volatility and how it can impact your option trading. So I want to show you right here, we see Seagate. Seagate reported earnings last week. And so here, this is the pre-earnings options data. As you can see, as I took this screenshot, Seagate was trading at $61.45. Now, the day before Seagate reported earnings, the at the money 61.50 strike right here was going for, as you can see here, the last traded price was $1.74. And the implied volatility was 128%. Now, on the other hand, the put was going for, where's the last price here? $1.82, and the implied volatility was also 128%. Now, this was the day before earnings. Now, let's talk of what happens the day after earnings. So, again, here, Seagate is trading at 61.45, and then the next day, oops, there we go, post earnings. The next day, as you can see, Seagate dropped to 59.33. So, as you can see, it fell dramatically, and therefore, as you can also see here, let me just zoom in a little bit that we can see it. Now my little pen thingy is in the way. How can we get rid of this? We probably can, but here, what you should see in the lower bottom is that the price now of the 61.50 call is only a penny. Obviously, duh, because it dropped. So it's not surprising that the call is not worth anything. But here's the key. Here's the key. Look at the put. This is the put here. Even though the stock fell quite substantially here, it fell, as you can see, $3.62. $3.62. But the put only went from, as we saw on the previous page, $1.82. So it went up, because puts go up as the stock go down, to $2.51. So this means that the put only went up 70 cents. 69 to be exact, but hey, who is counting? And you see, this is how the volatility crush affects the option price, because even though the put is worth more now, it is $2.51 versus previously the $1.82, right? And it is now in the money, but it also lost a lot of value due to the decline in implied volatility. See, the previous day it was 128%, this implied volatility thing, and right now it is only the day after 96%. So you have to factor this in when trading options into earnings. Now, before we move on, and I'll show you exactly of what I'm doing and how it affects us as option sellers, let me just ask you, is this making sense thus far? Because if it does, do me a favor and click thumbs up. This way I know that you're with me, or just, hit the like button. So this way I know if you're finding this information useful at all. So let's talk about this implied volatility things and how is this measured, right? And you know me, I'm all about practical stuff, so I don't want to bore you with the math behind it, and I don't have to. The good news is that there are plenty of places online that calculate the implied volatility for you, and I want to show you exactly how you can see if the IV, this implied volatility, is high, low, or average. And here is the easiest way to do it. You compare the implied volatility to the stock's historical volatility for exactly the same time frame. And you see, here I'm showing you right now my account, and every account platform, broker account, right, shows you actually the implied volatility. So we'll take a look at this here in just a moment, because the volatility, the implied volatility, measures the market expectation for future price action. That's the implied volatility. Now, the historical volatility measures the volatility for a stock that already occurred over a specific time frame. And all you have to do to see if the implied volatility is high, low, or average, compare to the historical volatility. So let's say, because this week we have Apple reporting earnings. Apple. So let's take a look at the implied volatility of Apple. So I'm bringing up Apple here, AAPL, and I'm looking at the January 29th, so with 4 days of expiration, and I'm looking at the implied volatility for an Apple call that expires in 4 days from now. So this is here at the money. Apple right now is trading at 142. So this is the at the money call. And as you can see, for the call, the implied volatility is 71%. And for the put, it is 70%. So let's take a look at Apple right now on a chart. So I want to bring up Apple here. Where is my keyboard? There we go. Oops. Apple. And we are comparing this 70% here. Ding! What does it do? It refreshes when I don't want it to refresh. AAPL. There we go. Perfect. So here we are now looking at the historical volatility of Apple. And this is something that your charting software can show you. And here we're looking at the historical volatility over the last 10 days. See, for historical volatility, it makes sense to look at it in 10, 20, 30, 40 days increments. So here we want to go for 10 days. And as you can see, it is 37%. So 37% is the historical volatility. And right now, the call here is trading at what? 71%. So what does it tell us? It tells us that the premium on this call and also on the put is running more expensive than usual. So now we can see, and this is affected by earnings because as you can see here on my platform, you'll see that the E basically says that earnings is happening this week. Now let's take a look at the implied volatility of an at-the-money Apple call that expires, let's say, in March 19th. So March 19th, you see right now the implied volatility is much, much, much lower. Look at this. 43% for the call and 43% as well for the put. So if we compare this, and now we can go onto our handy dandy iPad again, look at the historical volatility over the past, what did we have, 53 days. So here we go for 60 days. And this is where we see that the historical volatility over the past 60 days has been 40%, 40.69%. Now compare this to the 43 and we see that it is pretty much in line here. So this means that the premium that are on calls and puts on options that expire in 53 days from now is pretty much average. Okay, now I know I'm throwing a lot at you, but is this helping thus far? Because if so, give me a quick like. This way I know that you find this topic helpful because, see, option traders are always talking about implied volatility and historical volatility, and now you know what it is. And now I want to show you why I don't sell options into earnings. Well, you already have seen in this example of Seagate why I don't buy options into earnings, because this volatility crush, boom, right, it's pretty bad. I mean, this is where even though the stock moves in the direction that you want to, your option premium is getting sucked out of there because of the volatility crush. You see, and this is where, as an option seller, you might say, my gosh, don't I want the premium to be as high as possible? And yes, of course you do. But let me make you very clear why I don't sell options into earnings. And if you have been following me for a while, you know that I love trading the wheel. And as part of the wheel strategy, we are selling options. And you see, earnings plays are hit and miss. And sure, everybody can get lucky. And most people who start trading expect their account to explode from one or two big trades. And see, this is where we have some stocks that are jumping just dramatically. Let me show you a few examples here. So we already talked about Netflix, and last week we had Intel, INTC, reporting earnings. And look at this. I mean, Intel, if we just go back over the last 3 earnings, so I want to actually take a quick screenshot of this so that you see Intel, oh my gosh, here, huge gap down right when we had earnings. Here we have another earnings play, and you see Intel here really crashed down hard. And then also here during these earnings, initially Intel went up and then started crashing down. And you see, some people like these earnings plays because they believe the hype that they can make a lot of money with very little work involved. But see, trading just doesn't work this way. Because in reality, the key to becoming successful in trading is consistency and growing your account systematically. And this is what I mean when I talk about generating SRC profits, right? We talked about this before. And SRC is an acronym that stands for systematic, because I like to trade what I see and not what I think. And this is why I use indicators and have a trading strategy that tells me when to trade, what to trade, when to enter, and when to exit. Now, SRC, the R stands for repeatable. And by trading my plan, I'm able to find repeatable profit-making opportunities. And number 3, the C in SRC profit stands for consistency. You see, I'd rather make slightly less money more often than bite off all my nails waiting for a big winner. And if you would like to learn more about how I generate SRC profits, you can check out a video that I created for you. I include a link in the description below. And as you know, part of my systematic approach to trading is to use the options wheel strategy and the Power X strategy. And so if you're interested in these, I'll link to it in the descriptions here as well. Now, especially with the wheel strategy that where I'm trading right now with you here, $250,000 account, is the idea is to get paid while you wait to buy the stock. And because I'm collecting premiums on the puts that I sell, I'm looking for stocks with higher volatility, right? Because this means making more money. And as a rule of thumb, I look for stocks with an IV, implied volatility, of at least 40%. So some of the stocks that I am in, for example, is Uber right now. So if you look at Uber, the implied volatility here is 66%. Another trade that I have on is Weight Watchers. The implied volatility, as you can see here, is 77%. Another trade that I'm in is HAL. The implied volatility here is 72%. So you get the idea, right? But I remember what I said earlier. The wheel strategy can relatively safely produce profits, but I don't want you to trade into earnings. At least that's not what I do. So I will not target options with an expiration date that includes the company earnings report. So this is why you see, for example, if we look at HAL, they just reported earnings. There's nothing on the calendar here. Uber is reporting earnings sometime in February. So we still have 2 or 3 weeks, and I have options. I have the Uber options here, 19 options that expire on January 29th. So as you can see, this is what the dot means here. I am trading options before we're running into earnings. Weight Watchers is another one. So Weight Watchers, as you can see, earnings here is February 23rd. You see it on the right-hand side of my screen, and I have options. So here I have 44 options that expire this January. Okay, so this is why I think it is very important that you know when trading options, whether it is buying or selling, that you don't trade into earnings. At least that's what I do, because earnings are a wild card and there's just too much uncertainty. Remember, I'm not looking for fireworks here. I'm looking to systematically grow my account through consistent and repeatable strategies. And again, if you would like to learn more about the strategies, there's a playlist for you right below, because I made several videos for you, so I'll link to it in the description. So anyhow, now you know why we don't sell options into earnings. Now, we talked about that there's some earnings coming up this week, so I want to give you 2 more examples of 2 big companies that are reporting earnings this week. So a few that might be worth watching. Let me just bring up here my handy dandy iPad and show you what is happening here. Well, one of them is Microsoft. So MSFT. There we go. So Microsoft, as you can see, the historical volatility, actually let me change this back here to 10 days. So this would be over the past 10 days. There we go. Not that many days. 10 days is enough here. Hit OK. So we see that for Microsoft, for example, the historical volatility over the past 10 days is 27.98. So around 28. And if you look at Microsoft right now and the implied volatility, SFT, we look at the implied volatility of an at-the-money call, it is 48%. So it's slightly higher here. It's not too bad because, I mean, Microsoft usually is not moving as much. But let me show you another example. So let's actually talk about Facebook. Oh, yeah, now we have some more fun, right? Because Facebook, let me actually bring this up here. So Facebook, if you look at the historical volatility, meaning how much it has moved over the past 10 days, it is 45.97. And all of this is always, so this would be 46%. Again, I don't want to bore you with the details how all of this is calculated, but it is 46%. This is how Facebook has been moving. Now let's take a look at the option chain of Facebook and let's see how much the implied volatility is, and the implied volatility is 72%. So as you can see, this means that option prices are more pricey than usual. Now, I want to give you two more resources because if you want to see for yourself who is reporting and when, I want to give you two websites that are pretty cool that I personally use. So the first one here is stock earnings. Let me bring up my iPad. If you go to stockearnings.com, or they even have stocksearning.com, so even if you misspell it, you see the notable earnings that are coming up this week. And if I'm just showing you a few here so that you might recognize a few of the bigger names. So for example, eBay, you see that 3M is reporting earnings. We have American Express, we have Johnson & Johnson, Verizon, AMD, we have Microsoft, we have Starbucks. So all of this is happening tomorrow, as you can see. That's what I said. It's a pretty big week for earnings. Then on Wednesday, as you can see, we have going on here Boeing, we have AT&T, we have the Blackstone Group. So we have quite a few, and you can always load more. Now, another one that many people like to use is earningswhispers.com. So that's another great source for finding out when companies will report earnings, because this way you can make sure that you're not trading right into earnings. That's always good to know when they report earnings. If you have any open positions, whether you're buying stocks or selling stocks, so that you're not caught off guard. So I hope that this helped you to see how earnings impact option prices and why I never sell options into earnings. Has this been helpful at all? Because if it has been, do me a favor and click on like really quick. This way I know what videos you are enjoying, and I will do more videos of those. And also, if you would like to see more videos like this and enjoy this part of the show here, click on subscribe and hit the little bell, because this way you get notified whenever I release a new video. All right, fantastic. Well, it's so good that you're here, because now we're going to do a deep dive and look into your questions and see what's happening. So if you're watching this live, feel free to type in a question in the chat. That's probably popping up somewhere there. If you're watching the recording, leave a comment below with a question or a comment. Just say, was that good? Was that easy to understand? I'm just curious in your feedback in general. Really, really appreciate it. So good to see everybody here. And yes, I will very shortly talk about cryptocurrencies, probably next week. Because for this week, I have two more very exciting episodes planned. One of them being an update on my $500,000 account, right? So how is that going? And we will do this on Friday. Absolutely. So yes, we can absolutely talk about GME in just a moment. So we'll get back to this. And I'm actually planning to do a dedicated video on GME. GameStop. Oh my gosh, what a story. So yeah. Alex is also asking, what the hell is going on with GME? I'll tell you in a moment. I just want to make sure that right now, I first want to answer questions around implied volatility, historical volatility, since we just talked about it, and then we go to the other questions that you have here. Absolutely. So good to see you. Adam says, yeah, what a day thus far. For sure, in the markets. I mean, at first, let's just see what's happening here in the markets. So I want to just bring up the Dow really quick so we can take a look at this. And I just switch over here. We can get rid of the historical volatility for a moment and look at a... Oops. There we go. It's not yet sharing. And look at a 5-minute chart of the Dow and see what happens today. And you see, this morning, this is where we opened, right here. There we go. So we opened right here, and then, boom, we were crashing down, and now we are clawing our way back. So, yeah, it has been quite a day in the market, for sure, Adam. Absolutely. Absolutely. So Marcy says, should you close option trades before earnings? You see, this is a question, Marcy, that I get all the time. And this is why I wanted to do this video today in this show to tell you, yes, whether you're a buyer or seller, most of the time it does make sense to close it. And you see, this is why in PowerX Optimizer, if you are looking at any position, so let me switch over here to the charts. See, this is why we show you here when exactly our earnings are reporting. So if you looked at the scanner today and you had a few coming up, and I think the most interesting one obviously was, at least for me, DBD. If any of the bunch, this was the most interesting one. And you see, that's what we do with PowerX Optimizer. We show you when the next earnings are so that you know when those are coming up. So PowerX Optimizer is the tool that I personally use every day to find the best trades according to the PowerX strategy and also the wheel strategy. If you would like to learn more about this, I'll leave a link in the description to a website that I created for you. It's called mytradingroutine.com. On that website, I think it's an hour-long video where I show you in detail my personal training routine and what I do every day. But Marcy, yes, absolutely. I would definitely close it. So anyhow, good. So Sama says, nice day for PowerX Optimizer, up $2,500. Yep, can't complain. Okay. Ali says, I like the update on the $500,000 account frequently. Which strategy are you using if the market is heading down for some time? In this case, I would probably use Theta Kings. We'll cross this bridge when we get there, right? See, I'm not one for a lot of woulda, coulda, shoulda, hypothetical, right? I mean, this year is about real trades and what I'm doing right now. Because I can drive everybody crazy about saying, oh, and here's what we could do if this happens, and here's what we could do when that happens. But it doesn't help you, right? I mean, you probably want to know, how do you trade this market right now? And this week, we will see some more volatility in the markets. I talked about this earlier with my mastermind members because we had our strategy call. We have it every Monday. And this is where I said, okay, what to expect this week? Volatility. Because 20% of the S&P 500 stocks are reporting earnings. 25% of the Dow stocks are reporting earnings. And earnings right now, as you know, they are kind of hit and miss. So if you look at some notable earnings that happened recently, so absolutely we have, of course, Netflix, boom, that had this huge gap up. Oh, I'm still on a 5-minute chart. This is why it looks so odd right here. And then we had Intel, IBM. We also had BAC, Bank of America, reporting earnings. And you see after this, boom, going down. And somebody said, financial banks with all this money printing and all these loan giving out, can they lose money? Oh yeah, Bank of America does. So this is why always trade what you see, not what you think, right? Okay. All right, let's see what other questions we have here. Good. Okay, so I see Timothy says, I've been asking for a volatility lesson, so this is important to me. And there you go. This is why I say, if you have any topics that you would like me to cover and talk about, leave a comment in the comment section underneath the video. I'll look at all of the comments, and when I see that there's some interesting topics, I will absolutely cover it. So hope that this helps. Timothy, good to see you here. Okay, so Tulio says, what sources do you use to find the IV, implied volatility and historical volatility? Again, the implied volatility is easiest to find on your broker platform, because at first you have implied volatility for all strike prices here for a certain expiration date, and then you have it for very specific options that you might be interested in. And what most traders do is that they look at the implied volatility of the at the money option. So at the money call or put. This makes sense? And now the historical volatility, I mean, I like to use TradingView, and historical volatility is a built-in indicator. So all you need to do is go to indicators, and then you search for historical volatility. And this way it is bringing it up right underneath your chart. And then you can adjust the look back period and say, do you want to look back for 10 days or 20 days or 60 days? And as I said, it's very common for the historical volatility to look back in 10-day increments, right? So 10, 30, 60, something like this. Okay. Is this helpful, Tulio? Good. Peter is asking, does Markus take questions on this show? Peter, there you go. Just took your question. Okay. All right. Yes, and I know that there's so many questions coming in. And Peter says, on the $500,000 account update, if your wheel trades go and stay in the money, then with assignment, you will hold over $500 in stocks. Am I understanding it correctly? No. I probably at around $400,000 in stocks. And yeah, that's absolutely planned. That's planned. That's part of the wheel strategy. And again, if you're new to this channel and would like to learn more about this, I'll leave a link to a playlist there. And yes, I have been writing a book, and it is going to the printer probably tomorrow. So we just today, this morning, I sent 2 more minor things to the designer for the cover. I actually, I don't have it here. I'll show it to you in the next Coffee with Markus. So we do have a cover for it already. So it is coming up. Anyhow, yes. But yes, I will hold a substantial position in stock. And this is when I start selling calls against it. So it's part of the plan. It is part of the plan. Okay, good. So let's see. What other? J.R. Ewing is asking, what is IV rank? I believe this is where stocks are being ranked according to their volatility. I'm not really quite sure. It depends where you see it, right? I mean, if you see it on your broker platform, just look up the support files and help files and see what does it mean, the IV rank. But it's usually where stocks are being ranked according to implied volatility. So the ones with the highest implied volatility are on top. The ones with the lowest are on the bottom. And of course, we are interested in selling, well, that's what I told you. I'm most interested in selling options on stocks that have an implied volatility of more than 40%. And the recent examples that I've shown you are usually at around 70 to 80%. So that's what I'm looking for. But great question. So another great question from Fire Mip Spy is, how long after earnings will you wait before trading the stock again? You can do it right away because this so-called volatility crash happens the day after earnings. It usually happens right after earnings. So you can do it the very next day. Great question. Great questions. Okay. So let's see. What other questions? We will get to GME and Palantir and AMC and all this stuff. Yes. Absolutely. Juan Pablo, so good to see you here. Glad that you found it helpful. Absolutely. Okay, let's see. Derek says, what if you're put to a stock and it has earnings in 2 weeks and the price drops 10%? You sell call for 2 weeks. Do you BTC the calls the day before earnings if you haven't break even? You see, I like to, if I can. So I'll give you one example. One example, Derek, I did have ATVI puts, and I had them until the day before they released earnings. And this was the first loss that I took with the wheel strategy, and I've made $10,000s of dollars, and this loss was $60. So yeah, at that point, Derek, I did have the puts, and I couldn't get out of this, so I closed them with a super small loss. Again, loss of $60 compared to the $10,000s of dollars that I've made with this strategy, and this was the only loss thus far that I've realized. Is this helpful? Good. Caleb is asking, why not look at TradingView to see if earnings are coming up? I found that stock earnings and earnings whispers are more accurate than TradingView, even more accurate than your broker platform. Often you will see that Think or Swim, for example, or even Tastyworks is reporting earnings, but then it is the wrong information. So Caleb, I recommend that you don't need to subscribe to these websites. These websites are free, and I found them to be the most accurate out of all the information. So again, I have the information for Facebook. You see, I have it right here. So I know that earnings are on January 27th, and you see it says this little bell and after. So it shows me it's after the bell. And yes, I have the same information here on TradingView, and for Facebook, they're matching up because obviously it is happening tomorrow. Well, actually, look at this. It says 27th. Was it the same here? Yeah, January 27th. There we go. But I really found that when you go to stockearnings.com, that they are the most accurate, because sometimes you will see, and it seems that right now everybody is super interested in this and visiting this website, and this is why the website is responding really, really slowly. But when you go there, I found this the most accurate and most reliable. Doesn't want to load right now. Anyhow, great question. Okay, good. Eduardo says, I want my wheel strategy book. It's coming. So Alex says, do earnings affect other companies? Usually not. So you see, for example, we know that Intel and AMD are closely correlated, right? So let's just go to this and let's see what happened to AMD as Intel was actually here getting crushed. So let's see what happens to AMD at the same time. It's not going anywhere, right? So I wouldn't necessarily, Alex, it's a great question, right? Do earnings of one company affect another company? Usually not. Now, and I say usually because, for example, if Apple is reporting bad earnings, it might be bad for their suppliers, right? But I wouldn't overthink it. Alex. It's a great question, though. Okay. Good. So, John, was so good to see you here. Absolutely. And Alfredson says, how do I put the ADR on my chart in TOS? Don't know. I haven't used Think or Swim in years, so I'm not quite sure. But I'm absolutely sure that maybe somebody can help with this. There must be videos. I mean, this is 2021. Absolutely. Good. David says, you said you do not buy options into earnings. Is the same true for selling options? Yes, great question, David. And I think I answered it a little bit earlier, right? So whether you're buying options, right, into earnings, then you have the volatility crush that can really suck the premium out of your options. And when you're selling options into earnings, the stock can drop dramatically against you. So say you're selling puts and then the stock drops 10 or 15%, then you're in trouble, right? So this is why, as a general rule of thumb, I avoid it. So, and this is why you need to keep an eye on earnings. And this is why I thought I'd do the video today, because this week is the week where you have a lot of earnings coming out. And yes, it could be that you owned Netflix and then Netflix reports better than expected earnings and boom, the stock goes up like crazy and you're lucky. But I told you, I am not for lucky. I mean, if you want to get lucky, play the lottery. I just heard that somebody won $1 billion in the lottery, right? I am all for SRC profits, systematic, repeatable, and consistent. So my recommendation would be do not hold any options, neither buying nor selling into trading. Okay. Good. So Republic says, do you lose money if you let the contract expire? Well, it depends. If you are a buyer of the option, and let's say you're paying $1 in premium to buy this option and expires worthless, you lost $1. Now, on the other hand, if you are a seller and you sold somebody it for $1 and expires worthless, you keep the $1. So Republic Videos, it really depends whether you are an option buyer or an option seller. Usually, when the contract expires worthless and you're an option seller, you're making money. And if you're an option buyer, you're losing money. This making sense? Good. All right. Let's see. So Michael says, does the PowerX optimizer include the wheel strategy? Yes, it does. So what the PowerX optimizer does, it actually has two scanners. One scanner, this is the one that you see here, is for the PowerX strategy. And then see on top here, the wheel calculator. And here we have a scanner. Let me just zoom out a little bit. There we go. So this is where you have the wheel scanner and also the wheel calculator for the wheel strategy. So yes, you have both in one. Let's see, who asked the question here? Michael. So yes, the PowerX optimizer, it's the tool that I use every single day. It's the tool that I use to find my trades, what I want to trade. And it's an open tab on my computer all day long. And yes, absolutely, it is both included in here. Okay, so let's see. Piotr says, how to see your alert service versus PowerX optimizer? Which one is meant for who? You see, the alert service, I'm probably issuing 2 to 3 alerts a week. This week, today, I haven't issued anything just yet. Maybe I'll issue something tomorrow. So it's maybe 1 or 2 alerts per week. But if you have the PowerX optimizer, this is where, look at this, you're getting a lot of choices every single day. So if you are more of a hobby, a casual trader, then the alerts are for you. If you are serious about trading and if you really want to take your trading account to the next level, I highly recommend looking into the PowerX optimizer. And I mean, Paul will be happy to give you a tour of PowerX optimizer. So if you want, you can arrange a call with him and he shows you what this software does to see if it is right for you. I'll leave a link in the description where you can schedule these tours with Paul. Paul has been using PowerX optimizer for a little bit more than 2.5 years now, coming up on 3 years. So he's super qualified. He's one of my students. And he just said, oh yeah, I'll be happy since I'm trading a little bit in the morning. So in the afternoon, I'll be happy to show everybody what this tool can do for you. Okay. Good questions here. I mean, this is really great. So let's see. Lubomir says, I understand why it's important not to buy options, but I don't seem to understand why not selling options prior to earnings. Well, so let me just, because it's super important that you understand it. So let's just say that you're looking at, for example, Facebook, which is reporting in 2 days from now. And let's say you're looking at Facebook and you think, oh my gosh, yeah, Facebook, it'll just go higher. And you are selling a put with a strike price of, let's say, 265. So right here, right? Because you think it'll go higher. Now, if Facebook reports earnings and the next day opens at 245, you're losing $20 per one share, and options come in 100 packs. So this would be 100 times 20. So you would lose $2,000 if they gap down. So this is why you see earnings. That's what I said, Lubomir. Earnings are a wild card. Maybe Facebook doesn't respond to earnings at all. Maybe they just say what everybody wants to hear and we keep trading right at this level where we are at around 278, 280. Or they report much worse earnings and it plummets. So it's kind of a gamble. This is why I wouldn't do it. Okay. Good. So Sadav says, why did the market start to go down like this today? Who knows? Honestly, no apparent reason. So the market, let's just take a look at this one more time because I think it's a great question. Because the question is always, why does the market do what it just did? So I want to go to the Dow, and I know that I'm not sharing my screen yet. So let me just do it now. There we go. And we are going to a 5-minute chart so that we see exactly what happened here. And I want to show you where we opened this morning and what happened then. So let me just go to the markup. And so we opened this morning right here. Actually, no, we opened, sorry. Ha 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 ha. Caught me there. Right here. So this is where we opened. So we opened pretty much where we closed on Friday, and then at first we went down, and then we went up, and then we went down again, and then we went up, and now we went sideways. And we are pretty much a little bit down again on the Dow, so we're not quite there yet where we opened, because this would have been here. But overall, not much happened. So why? What is this nervousness? And this is the nervousness that we see right now because we have several key things that are going on this week. And number one, we have earnings that are being reported. Number two, this week on Wednesday, we have the FOMC statement. So this is where traders are a bit nervous. Okay, what will Fed Chair Powell say? Will he say, well, even the $1.9 trillion stimulus is not enough. We need more stimulus than $1.9 trillion. And this is when the markets could get nervous. Number three, on Thursday, the GDP numbers of the last quarter will be released, telling us how well or how badly did our economy do. And then number four, we also right now have President Biden with new initiatives. And right now he is super busy signing executive orders. And I heard that he is signing more executive orders than any president has in the first few days. Not quite sure if this is true, but he seems to be super active. And so we basically have here a 4 whammy this week. And this is why traders are just a little bit nervous. And this is what we saw this morning. And this is what I expect going into this week, that we will pretty much have a volatile week where we could actually go up and down. We could actually have two massive down days where we go down maybe 2, 3, 4%. We'll see. I don't expect this week the market to crash, but if we have a lot of the companies that are reporting earnings are reporting worse than expected earnings, it could send the market in a downward spiral. So we will see. So APT is asking, is implied volatility ever lower than historical volatility? No, usually not. I mean, usually implied volatility, because this is where traders are hopeful and they always hope it's getting better. So this is where when we try to predict the future, traders are more optimistic when it comes to predicting the future. So this is why I want to say probably 95 out of 100 times you will see that the implied volatility is slightly higher. But you get the idea. That's what I showed you earlier. If the implied volatility is 128 and the historical volatility is 40, you know that option price will be super expensive. If the implied volatility is 47% and the historical volatility is 43%, you know it's pretty much in line, right? Anyhow, all right. I know that we have been covering a lot. And so I know that there was still a question on GME. Here's what I'm going to do. Because GME, PLTR, a few others have been going so crazy, I will record a special video for you, or I will do a very special coffee with Markus. So give me maybe the rest of today. I'm pretty sure that I can do this tomorrow. So do me a favor, subscribe to the channel, because I want to show you exactly of what happened there, why it is so dangerous, how you can take advantage of moves like this, because you might have seen it in the chat. Yeah, if you were on the right side of the move, you might have made 200%, 240%, but I also show you the dangers of this. So click the subscribe button, hit the little notification bell. This way you get notified when I release a new video, and I'm planning to do a special on GME, GameStop, Palantir, and a few others that went crazy, probably later today or tomorrow. So until then, I will see you in the next video. Hope you enjoyed the show. If you did, click on like and share it with as many people as possible. Take care, and I'll see you very soon.